If you clicked on this video, you're probably concerned about the prices in the stock market plummeting because things just feel a little bit weird, and you've taken a look at the last few days of losses and you decided, okay, I need to figure out what exactly is going on. Or maybe you're just suspicious of the number of winners over at Wall Street Bets in the last few months and you're thinking something is not completely right. No matter what, you've come to the right place. We're going to break down all the warning signs in the market right now and what it means for our investments. Just make sure you stick through to the end of the video. That way you can help build a better picture of what exactly is going on right now. And let's start off by talking about the recent past. The US stock market just recently had its best 100-day gain since the chocolate chip cookie was invented. Seriously. We saw over 50% gains in those 100 days, resulting in some record high markets in the middle of a pandemic, record unemployment, and WAP topping the Billboard charts. Something just doesn't quite line up here. This bull run has hit a bit of a wall in the past 2 days. As of the recording of this video, the S&P 500 dropped nearly 5%, the Dow Jones dropped 4%, and the NASDAQ composite was hit particularly hard with 7% in losses in the previous 2 days, costing our tech overlords $25 billion in that time. These minor corrections have made just about everyone question if the sky is falling and if the end is near. So first, let's talk about a few reasons why the markets are as high as they are. Starting off with some fundamentals. The price of a market is a function of supply and demand, not the health of an economy. After all, a tweet from the president may have a greater effect on the market than the actual health of the economy on any individual day. Yes, people may purchase more of an asset if they believe the economy is healthy, but many people also buy an asset if they think someone else will later buy it for a higher price. This is called the greater fool's theory. It's easy to think of a market as a pie with a limited number of slices. If the supply, the total number of slices, doesn't change, but investors want more slices, the price of each individual slice increases. This is an important distinction because it's easy to think that the stock market equals the health of the economy, but this just simply isn't the case. The reality shows itself most often in the reaction to news. Stocks typically increase or decrease disproportionately to positive or negative news. A perfect example is Tesla stock dropping 9% back in 2018 after Elon Musk smoked some weed on a podcast. The company's earnings, or lack thereof, revenue, and prospects all stayed the same, but the stock dropped by billions in value. The same thing can happen with an entire market. So, what factors cause the market to go up so dramatically in the first place? Well, the first answer is loans, and a lot of them. The Federal Reserve gave $1.5 trillion in short-term loans to banks back in March to, quote, address highly unusual disruptions in Treasury financing markets associated with the C word outbreak. They didn't actually say C word, but I'm trying not to get demonetized over here. Next, the Federal Reserve started the Main Street lending program in June, giving large loans to businesses with fewer than 15,000 employees. The purpose of this program being to give businesses in good financial shape more favorable loan terms to help with debt obligations and ultimately give them a better chance of survival in this massive downturn that we're seeing. The important thing to remember about these programs is although they put more money to work within the economy, they are still loans and eventually need to be paid back. It's kind of like, let's say your friend somehow got a $500,000 loan and bought all sorts of cars and toys with it. He might look like he has a lot of money, but in reality, he's $500,000 in debt and that needs to be paid back at some point. The next reason markets are high is because of interest rates. Rates are at a near all-time low, and because of this, many investors don't want to keep their money in a bank account where they'll make a near zero return. An investor is going to put their money to work in an investment, something like real estate, collectible Beanie Babies, or stocks. And why is any of this important? Well, let's go back to our supply and demand equation. First, investors don't want to keep their money in the bank where inflation is going to eat away at it. So more money is going into stocks, and if more stocks are being purchased, the entire market goes up. The next reason markets are doing better than we think they should be are enhanced unemployment benefits and the hope for future stimulus bills. And these are pretty artificial reasons. Enhanced unemployment was great. It gave those who were negatively impacted by the pandemic discretionary income to pay for the necessities, things like rent, food, clothing, OnlyFans accounts, the necessities. This by default helps out the companies that they are purchasing things from, which in turn props up markets. The problem here is this is spent money that is not earned by producing anything. Typically, you go to work, you earn some money from your work, and then you spend that money at places where other people are working and producing. Typically, the economy is being productive at every level. These unemployment benefits have the short-term effect of positive spending minus some of the productivity. This can only last for so long. Then the hope for future stimulus bills has the news effect that we talked about just a little bit earlier. Because it has looked like we will see another spending bill coming for months, investors have bet on the economy by purchasing more shares and driving up prices. This is all in anticipation for future spending and future earnings that are not realized yet. So now that we know what is happening in the present day and how we got here, let's talk about the warning signs that we're seeing now. The best word I can think of to describe the markets right now is peculiar. And I say this because if you ask just about anyone if they feel stocks should be at near record highs or if the economy is healthy right now, they would give you a flat out no. But yet, here we are. Coming into the pandemic, we saw the longest economic expansion in history, 128 months. And even then, despite having high levels of spending and low unemployment of around 3 to 4%, many investors felt that a major correction was needed then, despite that health of the economy. Well, here we are, 8 months later, in a worse situation economically in just about every single way, yet markets are as high or higher now than they were at the end of that record 128-month bull run. So let's look at some more warning signs, starting with consumer spending. It has gone down 11.5% since the beginning of the year. Just to put that in perspective, that's equivalent to 325 billion Big Macs or 360 million brand new Vespa scooters, all in goods not purchased this year. Moving on from here to unemployment, it went from 3 to 4% up to 14.7%, and then back down to 8.4% in the most recent month. Now, this is one of the most misinterpreted pieces of data in the recent past. When the report came out in April that unemployment was 14.7%, everyone was justifiably scared. However, since then, every single month, certain investors and politicians have cited unemployment as a positive indicator of the economy. In May, 13% unemployment was used as a reason to hold off on future spending bills. Yes, recovery is good. Going from 14.7 to 13% is progress, but 13% unemployment is still worse than nearly everyone alive has seen in their lifetime. Even now at 8.4%, we're at nearly 2.5 times more people unemployed than there were this time last year. That's 2.5 times more people who don't have extra money lying around to buy things and give our businesses more revenue and more earnings. So finally, let's look at the Buffett indicator. This is the total market cap relative to the US GDP. Basically, the total stock market value of all US public companies divided by the total value of all final products and services produced in the country. Warren Buffett says this is probably the best single measure of where valuations stand at any given moment, and he's a guy who knows a thing or two. In a typical investment, you want to purchase something that is priced less than the value it creates. This ratio tells us what theoretical return you could expect if you could invest in all public US companies at current rates. Basically, if you calculate this ratio and you get a number higher than 100, there is a case to be made that stocks are currently overvalued. So let's look at where we are today. We're using currentmarketvaluation.com because they do an excellent job of, determining the current market valuation. It is shown that our Buffett indicator is currently 67% higher than the historical average, which means the market is strongly overvalued. You can see the last time we saw numbers this high was the internet bubble back in the early 2000s, and we all know how that panned out. Here's a graph of the historical US GDP overlaid with the historical total market value. You can see that the market value can swing wildly in extremes, but always eventually gets pulled back into reality by the GDP. This graph may also show a reason why Buffett himself didn't make any big purchases when stocks sank back in March and April. We can see that this ratio shot down in those months. However, at its lowest this year, it still could be arguably an overvalued market. From here, we're left to decide what may happen next. However, unfortunately, that's an impossible question to answer in the short term. The market is not rational in the short term. However, we can bet that with enough time, things will come back to reality. After all this stock talk, if you would like to receive one free stock valued between $12 up to $1,400, check out the link in my description for Webull. All you have to do is deposit $100 into your account and you'll get a free stock, and you don't even have to spend the $100. So this is all I have for today. I'd like to thank you for watching, and I hope you have a profitable day.